Hey, good day everybody. Bob Trade Genius. As promised, I'm going to talk about how the Federal Reserve and their opaque activities and the banks and our central government use the bond market to manipulate the price of gold. There's an inverse reaction to gold and the 10-year yield, and that they're in competition with each other, and also that the 10-year yield, as it rises, it becomes basically a substitution out of bonds into stocks, and there's this fetish that everybody has about keeping the stock market elevated, and for a lot of really good reasons they need it elevated, because not the least of which is the pension funds, and it's a scorecard, and people's retirement, and so they're desperate to not let this thing crash again. Plus, I think the Fed will be out of business during this next crash. And so here, just a quick look here is 1st of September. Here you notice that the 10-year yield bottomed, and if you go to GLD, the 1st of September, essentially gold topped. And then we get to the end of September, back to TNX, and you see the bottoming here of the interest rates, and then you go back to GLD and you see a bottoming of gold and for it to pop. And so the thing that we have to now look for is for this move for TNX to exhaust itself. Is that, if you notice here, this is a daily, this is 65 period moving average. This is my favorite bull bear moving average, and every time price attempts to achieve that level, it's getting rejected, and it's not just a short-term thing. Okay, look at this. All right, it goes back quite a few, all the way back into 2018. All right, so this is a pretty big move down. I mean, almost half the rate in the 10-year. And so now we have to just to see here if this holds at this time, or if we're trying to carve out a kind of an inverted head and shoulders here. My view is that it'll probably reject again. There's just no appetite for higher rates. I think it becomes counterproductive really fast. Too many S&P 500 companies are underwater, and if in terms of their interest payments on the debt to be able to buy back shares. And that story's ending too. And so we just have to keep an eye on this here. But if it does break out, it's not good news for our gold and silver miners, at least short term, until the inflationary effects of the QE that's coming becomes more prevalent than the games they're playing on the 10-year yield. And plus, if this thing breaks out, it screws up even more the housing market, and the building market, and the auto market, and credit card rates, etc., 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 etc. And so it's just something that we have to keep an eye on. And so, if you do like to trade the miners and stuff like that, is that we just have to be conscious of the fact that this is competition to gold, and you have to plan accordingly. And these guys they don't tell us what's going on, so you just never know when they're going to start pulling the trigger on these moves here. But just keep an eye on this, and that should give you some insight as to what's going on. And then right now, my view is that you saw my view on SPY yesterday, is I think that'll support gold, silver, and the miners if we get a roll down in the market again on the fake trade news, and then we should get a bid then under these risk-off assets again. Anyway, I'll catch you guys later. I'll be talking food, natural gas. I'll doing a whirlwind tour of the ETFs and just a lot of good stuff. 3-day weekend. I'm going to be bombing you guys with videos. Have a good one. Talk to you later. Bye-bye.